everyone. Thank you for taking out time to joining us for this session. Before we welcome our esteemed speaker for today, I would like to just set a context for today's session. With almost 2 quarters into this year, we have seen a fair bit of action already. We had a very good budget, a sanguine tone for the domestic front, but the incidents and debacle on the developed markets banking system brought us an element of uncertainty. Though the aftermath led to a volatility, the market have eventually subsided. Uh, but there's a reopening of China is giving us some good cheer. But at the same time, the Europe and Western world still is on tenterhooks of the banking crisis. Asia, India specifically, has given a preferred destination of investors. Over last 2 months, we have already seen an investment of over 50,000 crores by FPIs. FDI continues to be extremely strong, and that has led to a context. MD and CEO of Kotak Mutual Fund and has a decades of experience on the subject. He's considered as one of the industry's biggest thought leader in the world of investment and finance. Without much ado, I will hand over to Nilesh Bhai. We will take questions at the end, so you can post your questions online, and we will take them at the end. Over to you, Nilesh Bhai.
Thank you, Manish Bhai. Very good afternoon to all of you. From an economic point of view, if we see, India is doing extremely well. We are oasis in the global desert. Our growth is driven by government's infrastructure spending. The trade, exports, and services are also now contributing positively to GDP growth. The only sector of economy which is not doing well as per expectation is consumption. Rich and upper middle class consumption is growing. The lower middle income and poor consumption is subdued. We have to hope and pray that consumption also picks up, just like investment has started picking up in private sector. Today, our fourth quarter GDP growth number has come ahead of expectation. Full year FY23 growth is fastest growing in major economy. This growth is not funded by injudicious, imprudent borrowing. Unlike US, which has to borrow $3.5, $4 to raise $1 of GDP, we are creating $1 of GDP by borrowing 90 cents. Government is leader in investments. Election-bound government not only allocates higher money to infrastructure, but also speeds up execution. As capacity utilization has improved, private sector has also started investing. The only subdued part of economy is consumption at the bottom end, consumption in the lower middle income and poor people. In that context, if we look at equity market, three things drive equity market: flows, sentiment, and fundamentals. Flows and sentiment can change very quickly. Fundamentals are like oil tanker, takes time to turn around. From a fundamental point of view, Indian markets are fairly priced, roughly at about 18 times 1 year forward earning. It's neither cheap nor expensive. It trades at a premium to all emerging markets. This earnings growth is likely to sustain. Banks have recorded more than 2 lakh crore of profit. Auto sector is also showing high profit. IT, pharma are subdued and little below expectations. But who knows, they can turn around very quickly. Capital goods, manufacturing, cement, construction, more or less they are in line with expectation. So it will be fair to say that fundamentals are intact. in better shape than most other markets. And we are at fair valuation, which demands neutral equity allocation from investors. From a flow point of view, market is heavily biased towards money. Foreigners, after selling 250,000 crore between October 21 and June 22, have turned buyers. Mutual funds, insurance companies are net buyers in market every month. Retail HNI is also a buyer. There is too much of money chasing too few stocks in today's environment. Selling in market is driven by asset allocator funds or by some promoters like private equity and venture capital here and there. The government has also opened divestment program just last week. At least for the time being, it looks like flows will outstrip supply and keep market supported. If we look at from foreigners' point of view, Russia is absolute no to them. Brazil, South Africa are relatively weaker. China, whilst it's very, very cheap, but Bank of America research probably sums up Chinese market correctly. Too cheap, too short, too mediocre to go long. Turkey currency depreciation and economic policies are horrible. Net for global investors looking to diversify out of developed markets, foremost choice is India and maybe Indonesia kind of emerging market countries. More importantly, FPIs would have realized in all emerging markets, entry is easy and exit is difficult. Many a times you don't get to take back your money like Dr. Mark Mobius experienced in China. In India, exit is easy. You sold $35 billion between October 21 to June 22. Be my guest, take all your money back. Entry is difficult. You have bought in less than $9-10 billion and markets are already way above October 21 level. This being the case, my belief is that at lower level of market, at cheaper valuation, FPIs, retail, HNI, mutual fund, insurance, everyone will be a buyer. This will make market supported on the downside. This will keep market supported at the lower levels, cheaper valuations. Hence, it will be fair to say every correction is an opportunity to buy. Now, let's come to the sentiment side. From a flow and fundamental point of view, market is fairly priced, well supported, and every correction is an opportunity to buy. Sentiments will be always influenced by event. While global energy prices, Russia-Ukraine situation, Fed's interest rate policy, they all will have temporary effect on our markets. The biggest driver for our sentiment will be election results 2024. In 2004, market believed in India shining, got a jolt when voters didn't vote for it, and markets corrected 20% in a single day. 2009, market was worried about election outcome. Voters actually gave much higher seats to UPA government, and markets went up 20% in a single day. 2013, India was fragile 5. Market had corrected a lot. But from September 13, when there was hope that Narendra Modi-led BJP could form government, market started moving up. And well before May 2014, when actual results came out, bulk of the gains were achieved. What will be the situation in 2024? Will it be like 2004, where market before election believes India shining, and post-election gets a jolt and hence having a correction? Or will it be like 2009? Market will be worried about election outcome and will get a surprise with government coming with majority and hence markets will rise? Or will it be like 2014, where market starts discounting the election outcome and neither gets surprised nor gets shocked and hence remains where it is? With all our research capability, it will be impossible to figure out what will be the election outcome. We believe our fundamentals are in place. While a government can definitely influence speed, the direction is already well set. It will be futile to predict election and base decisions on that. Our recommendation will be to maintain disciplined allocation. And if there is a correction, then use that as an opportunity to go overweight equity. The emotional jolt of market eventually will get tapered off by fundamentals of Indian economy. We are on the path to become third largest economy in the world from fifth largest today. IMF believes that will happen in 28. We believe it will happen in 2030. And British institutes believe it will happen in 2032. But the journey of India from fifth to third largest economy is almost inevitably accepted by everyone. Today, as fifth largest economy, we are investing more than $1 trillion in fixed assets creation. This is fourth highest asset creation in the world. That investment also gives confidence that future looks brighter. Overall, we believe equity markets are fairly priced from a flow, sentiment, as well as fundamental point of view. While our economy will continue to do well and our markets will continue to get supported by funds, there could be sentimental effect of events like US Fed pivot, Russia, Ukraine, Indian election result, global energy prices. If those events are positive, markets will rise further. If those events are negative, markets may give correction. And that should be a great opportunity to become overweight equity from equal weight equity at this point of time. Should you go towards large, mid, small cap stocks? Well, we don't have a very firm view on large, mid, and small as valuations are near in equilibrium. Our call is that let's be marginally overweight large cap and marginally underweight small and mid cap. And whenever correction comes, use that as an opportunity to add to small and mid caps. Sectorally, banking has given blockbuster results. NPAs are low. Margins are all-time high. Profit growth is superlative. And most importantly, valuations are still reasonable. We believe banking and financial services will continue to compound and outperform the market. Manufacturing in India is a theme which is taking off, especially for those companies which can become part of global supply chain. Overall, we believe between manufacturing theme encompassing capital goods, infrastructure, construction, intermediate goods, all those sectors will continue to outperform the market. IT and pharma are going through tough time. There is uncertainty ahead, but they are probably in the process of bottoming out if globally something untoward doesn't happen. Valuations are reasonable, and as things settle down globally, ordering may start resuming, and that should benefit Indian IT and pharma. We believe over next 6 to 9 months, we will get opportunity to invest into IT and pharma names. Overall, we believe Indian equity is fairly priced, and it is time to remain equal allocation to equity and using dips as an opportunity to become overweight equity. With this, Manish bhai, I will end my talk, but happy to take questions.
Thank you, Nilesh bhai. Everyone can put their questions online. That will help us ask some questions. So we will start with some questions myself. So Nilesh bhai, you talked about that small and mid caps looks a little overvalued at point, and large cap allocations can be made. But what your sense on there is still a lot of catch up on the mid caps that is still visible. So do you think that from a long term perspective, uh, there can be SIPs which can be built into the small cap sector at this point?
So Manish bhai, as I mentioned, we don't have a very high conviction call because valuations of small, mid, large are almost in equilibrium. They are not that far apart that I could convincingly say yes on one side and no on other side. And which is where it's not zero small or mid cap. But if suppose your ideal allocation is 40% small and mid cap, then maybe run at 30-35%. Certainly not 45%. And whenever there is correction, try to add small and mid caps into your portfolio.
Got it.
Your SIPs in small and mid caps should continue. Small and mid caps have more volatility and hence are more ideally suited for SIP. So please continue with your SIP and small and mid cap. This call is more from an asset allocation point of view, where you can become marginally underweight small and mid cap and marginally overweight large cap. But this is not a high conviction call because valuations are not very far apart from their historical averages.
Yeah. Thank you, Nilesh bhai. While US Senate averted the debt ceiling crisis yesterday night, but what's your view on what will be the Fed's view on going forward on the rates, and how do you see the chances of recession in US now after this whole debate on the debt ceiling crisis that entire deadlock has been broken? But what's your view on how this whole recession story will pan out in US now?
So Fed is probably singing the song "Jate the Cheen, pahunch gaye Japan, samajh gaye na." They are maintaining a very, very delicate balancing in a very, very complex scenario. US is heavily leveraged. Debt to GDP ratio is 120%. Half of their debt is coming for refinance in next 2 years. The average borrowing rate on those debt will be maybe 1%. Now, average borrowing rate at current level of rates will be probably 4.5%. Imagine refinancing at 3.5% higher interest rate. The government of US does not have budget space to pay that large interest. The credit card debt is now in excess of $1 trillion. Student loan is in excess of $1.6 trillion. मनीष भाई, हमारे यहाँ पे लोग हाउसिंग लोन 9-10 साल में पे कर देते हैं. In America, student loans are going beyond 10 years. In a heavily leveraged society and government, Fed has no option but to keep interest rates lower so that growth can be supported. Fed pursued this till such time inflation genie remained under control. But US government in pandemic opened the doors of their vault, threw money, and hence turned around the inflation numbers. Now Fed is maintaining a very, very delicate balancing. They know they have to raise interest rates in the short term to keep inflation under control. They know they have to cut interest rates in the long term to keep US consumers, US government solvent. At what point of time they apply the brake and at what point of time they apply the accelerator will determine what happens in US economy. No Fed chairman would have gone through as intense pressure as current Fed chairman Jeremy Powell is witnessing.
Yeah.
While many analysts are scathing in their commentary about Fed, I think history will be kinder to Jeremy Powell as he maintains this delicate balance between inflation and growth. In the short term, he has to raise rates, and at the right time, he has to cut interest rates. Our feeling is that if you are asking me to predict US Fed rate for next 30, 60, 90 days, I will say there is one more rate hike possible, especially because of yesterday's blockbuster job number. If you are asking me what will happen between, say, 90 days to one and a half year, I don't know. But after 1.5 years, US interest rates will be lower, far lower than what it is today.
Got it. Got it. So I will come back to the Indian markets. So India also is still going through a very high inflation environment, while it has started cooling off a bit, but still rural consumption seems to be a challenge. So how do you expect the RBI to respond to this situation now?
So RBI also has to maintain delicate balance. They have done far better than Fed in containing inflation. In 16 out of last 19 months, Indian inflation was lower than American inflation, which had never ever happened in our history. Now, RBI also, like Fed, has to let go inflation and focus on growth, especially at the lower end of the pyramid. Manish bhai, interest rate on our housing, auto, and personal loan has gone up. Most housing loans are floating, so impact will be higher. Most auto loans are fixed, so impact will be almost nothing. In personal loans, because tenures are small, refinancing will ensure that people will have to pay higher interest rates. We believe, apart from overall inflationary impact on bottom end of the pyramid, things like increased EMIs, spending of money on cryptos and futures and options trading, spending of money on gaming like rummy and poker and cricket. All this also has contributed towards slowdown in consumption at the bottom end of the pyramid. And RBI at some point of time will have to look at cutting interest rates to lower EMI burden so that consumption can bounce back. Of course, RBI will not front run US Fed. So my feeling is that our rate cut will happen maybe between 1 to 3 months post Fed's first rate cut. Market today is believing Fed to cut rates by December 23 to Feb 24. Based on that, my feeling is that 2024 first half, we will see India cutting interest rates.
Got it. So, Nilesh bhai, a lot of questions are coming on the sectoral outlook because you spoke quite a lot about sectoral outlook. So, from your perspective right now, what are the top 3 sectors which investors should look at? What are the 3 contra bets which they should look at? And what are the 3 sectors which you may not like at this point at all?
So, Manish bhai, in a sector, good promoter creates value, like HDFC Bank or a Kotak Bank. And a bad promoter destroys value, like Yes Bank. So you have to not only select the right sector, but also the right promoter.
Yes.
Subject to that caveat, as I mentioned earlier, banking looks good. Deposit rates have not risen as much as the lending rates. All the borrowers like Nirav Modi, Mehul Choksi, Vijay Mallya has left our country. Thanks to CIBIL credit score, retail loans are also fairly robust. As interest rate starts coming down, while margins may get impacted adversely, the gains on investment portfolio will support the profitability. More importantly, valuations are reasonable. And if FPIs have to buy India, they are going to get quantum only in banking stock. Put together, banking looks like a compounder outperformer from here. If we look at manufacturing theme, it's a very, very broad theme. But like we saw in chemical sector, where exit of China created opportunity for Indian chemical companies, and they delivered superlative growth, both in terms of business as well as stock market performance over last 4 or 5 years. And last 6 months have been consolidation period, correction period. What happened in chemical sector is likely to get repeated in many other sectors. Electronic components, capital goods, cement, toys, this auto components. These are some of the sectors where Indian manufacturing is competitive and it's getting orders from global sourcing base. We believe if we put all these companies together as a basket, manufacturing in India theme will also do well. Two sectors where one should take contra bet, IT and pharma. There is bouts of uncertainty, global growth slowing down, US banking sector not in as robust condition as 1 year before. Will IT companies get orders? AI, will it replace humans? In pharma, US FDA has again started inspecting Indian companies, and some companies are coming under pressure. Put together, IT and pharma valuations are reasonable thanks to the uncertainties ahead. And my feeling is that over next 6 to 9 months, one should accumulate IT stocks in order to build a portfolio. Pharma is more company specific, but since we don't know which company's plant will get hit by US FDA, which company's product will get approved by US FDA, it might be better to go with a portfolio approach in pharma and build a portfolio over next 6 to 9 months, just like IT. So IT and pharma are your two contra sectors. 2-3 sectors which are worth avoiding. Well, it's always the promoter which are worth avoiding. But there are many companies where valuations are way ahead of their fundamentals. Some cases are because of investors' greed. In some cases, it is because manipulation by market players or promoters. By and large, this short-term momentum stocks are worth avoiding. They give you short-term gain, but long-term pain. So expensive, badly managed, badly governed companies are avoidable. IT, pharma, contra, banking and manufacturing are outperformers. But Manish bhai, now one will have to be, looking at moderate return. As our inflation has come down, the real return, if they remain constant, the nominal return from double digit may come down to somewhere around high single digit to low double digit. And which is why this asset allocation discipline of buying at lower levels becomes very, very critical.
Got it. And Nilesh bhai, what's your view on the PSU stocks? Because a lot of PSU banks and PSU stocks have run up a bit. Now, obviously, with Coal India, OFS, government has again shown some intent to put out disinvestment again as a theme. So what's your view on the PSU as a theme now?
So Manish bhai, we definitely missed PSU theme on the banking side, on the power utility side. We did make a lot of money on defense PSUs. But by and large, I have no hesitation in saying that we ended up missing PSU rally. prima facie, we are not very comfortable with businesses where shareholder value creation is not the most important objective. For PSUs, employees, country, needs of a country, they all get priority over shareholder value creation. Now, I'm not saying that you don't take care of employees or country's need, but priority should be shareholder value creation. A private company can stop retailing petrol if it is at a loss. But refining companies and petrol distribution, oil marketing companies cannot do that if they are owned by the government. That's the limited point. So my recommendation is that a lot of PSUs are doing extremely well. They are run by very, very solid management, very, very committed employees. But use them more from a trading point of view than from a long-term investment point of view. Buy when they are very, 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 very cheap and sell when they are cheap.
Okay, got it. Got it. So now the one controversial question. So obviously the new age companies. How do you look at new age companies now? Because they have beaten down very, very badly. Uh, Still, the US VC firms are now devaluing Indian companies in a big way. Farm Easy was battered down, Byju's was battered down, and lot many more examples are there. But how do you view the new age companies now in India, which is in listed space, something like Zomato, Paytms of this world? How do you view them now?
So Manish bhai, please remember that we are also learning the tricks. We are not expert on investing in new age businesses like venture capitalist or private equity funds. Second, by and large, most of the mutual fund investors, including Kotak Mutual Fund, are either value investor or growth at reasonable price investors. We all believe in cash flows. We all believe in businesses which are profitable. A business model which believes in getting the customer first by burning money and then figuring out a way to monetize is not something which we will accept easily. Partly we have become old. Partly for last 30 years, we have made money following this philosophy. So we are not going to become as aggressive as someone who is starting today his career. Now, keeping this in mind, by and large, we avoided some of the expensive new age companies. In some of the new age companies, we invested to taste the water. Our mind is open, but we want a business plan. We want a business model which will have profitability at its core. Burning capital to attract customers which can be monetized later. Well, you show me a roadmap to monetization before I can invest. So we are tasting waters in new age companies. A lot of valuations have corrected, but not all the companies have shown path to profitability. We will increase stake in those new age businesses where there is a path to profitability.
Got it. Thank you, Nilesh. Next one. So now we come to some other sectors and some other asset allocation. From asset allocation perspective, right now there was a lot of big rally happened in gold. So what's your view on commodities now going forward, especially gold as an investment class? Because gold, again, Indians hold a huge amount of gold, and the interest in gold remains very, very high in the Indian markets.
So Manish bhai, I'll talk about dollar gold first and then rupee gold. We believe gold in international market in dollar price terms will get supported. Last year, central banks of the world bought 1,000 tons of gold, more than what Indian housewives and households bought. And they are all driven by diversification. On the day of invasion of Ukraine, Russia had $650 billion FX reserves. By end of the day, they were left with $150 billion of gold, which became their official FX reserves, because $500 billion was frozen under the sanctions. Now, which country would like to take the risk of keeping all eggs in one basket of US dollar or euro or yen security? God forbid, tomorrow, if US doesn't like your face, they can freeze your FX reserves. Every central bank around the world is worried with the weaponization of dollar and secretly is buying gold. This will keep gold prices supported. Second, when interest rate goes up in US, gold prices suffer. When interest rate comes down, gold prices bounce back. We believe over next 3 to 5 years, there are more rate cuts than a rate hike, which will again be supportive of gold. So on a dollar gold price, we are bullish. On rupee gold price, please remember there is 18% tax incidence, 15% import duty, 1% GST and other charges. What you get for $100 in Dubai, Singapore is worth $118 in India. This encourages gold smuggling. I doubt if import duty will remain at such a high level so as to encourage gold smuggling. At some point of time, import duty will come down. That will have impact on rupee prices. Subject to that, one should invest in gold. Sovereign gold bond gives you interest. It does lock in your money for 5 and 7 years, but it does provide interest. And hence, that should be one convenient way of investing into gold. Second could be gold ETFs or gold index funds. The intermediation charges in gold index fund is far lower compared to physical gold. So that's our view on gold.
Thank you, Nilesh bhai. On the last asset class, so what is your view on the fixed income funds now? Obviously, that whole tax arbitrage on fixed income gone now. So how do you see where should investors look at money? Would they look at carry or accrual funds at this point, or they should start building some positions in the duration space as well?
So Manish bhai, from a near-term point of view, and this is called from, let's say, June to September, October, not beyond that, we believe 10-year yield has reached somewhere near its bottom. It did swing from 7.5 to 7. And now it needs to consolidate at current level before it can swing downwards. The downward movement on Indian interest rates will be driven by, one, what happens in US, and second, how much growth support is required. An election-bound government undoubtedly will put pressure on RBI to adopt easy liquidity and lower interest rates to support growth. Put together near-term consolidation in interest rates and thereafter downward journey, assuming election-bound government's pressure and US Fed's need, both will keep interest rates on the softer side. That being the case, it is time to invest in longer duration papers. But please remember that for a while, in the short term, that trade may not work out as well as last 6 months. To investors who are who are in higher tax bracket and who wants kind of safe investments like fixed income fund, can also look at equity savings scheme. Normally, the asset allocation over a longer period of time in equity savings scheme is 30% equity, 35% arbitrage, and 35% debt. They give you debt kind of return with slightly higher risk because of 30% cash equity. But that risk is justified because of the higher potential return and also lower taxes. So higher tax bracket persons can look at equity savings scheme as an alternate to debt investments.
Got it, Nilesh bhai. So, I guess we are run out of questions now. You have covered a lot. So, one final question from my side. So, what should be your investment strategy going into this election year now, and what should be our long-term investment strategy?
Long-term investment strategy, don't bet against India. No matter what happens, the work which we have done since 1991 through liberalization, and especially in last 8-9 years in terms of building infrastructure, will hold us very well. This is the journey of a $3 trillion economy moving towards probably 10x. We will see 10 times current India's size over next 2-3 decades. That being the case, it's better to remain invested. Don't bet against India. Ahead of election, I will maintain my disciplined asset allocation. I don't have any predictive ability to figure out what will happen in election results and markets. I will use every correction to buy and become overweight equity. This will be simple strategy. Be disciplined. Don't bet against India. Take the volatility in your stride by averaging on the way down.
Thank you, Nilesh bhai, for wonderful insights. Thank you, everyone, for joining us today. We will be in touch. We will do lot many more sessions with Nilesh bhai going forward. Thank you, everyone, for joining us today. Thank you, Nilesh bhai.
Thank you.
Thank you.